30 minutes from the close of trading here in the U.S., live from Bloomberg's world headquarters in New York, I'm Scarlet.
And I'm Joe Weisenthal.
The stock market's election week rally losing steam this Friday. The Dow Jones Industrial Average, though, still on track for its best week in almost 5 years.
But the question is, what'd you miss?
Global stocks gained $1.3 trillion this week. Investors are considering what a Trump presidency means. We'll be hearing from Tommy Sho, CEO of Keefe, Bruyette & Woods, on the future of Dodd-Frank. Meanwhile, bonds have gone pounded with losses. Traders are pushing down the value of government debt on bets that Trump's policies will boost inflation and interest rates. And we saw the same carnage in developing nations, where concerns about Trump's protectionist trade policies have sent emerging market stocks and currencies to record lows.
Let's look at where the major averages stand as we head towards the close. Bloomberg's Abigail Doolittle is standing by.
Happy Friday, Joe. And as for stocks, we do have the three major averages here in the U.S. shuffling right around even all day. In fact, we have the Dow fluctuating between small gains and losses throughout the day. So not a lot of action today for U.S. stocks. But on the week, it's a bit different story. As Scarlet was just mentioning, we have this massive rally. In fact, for the Dow up about 5% on the week for its biggest weekly gain in about 5 years. Not surprisingly, then, a big sell-off in bonds. Now, this is represented by the 10-year yield having its biggest spike up in yield ever, 37 basis points for about a 21% gain. So we're returning a little bit to more of the traditional relationship between stocks and bonds. Stocks have rallied, and the safe haven bonds have fallen off. As for the dollar index, it's really found a bid on that bond strength, or rate strength. Rising rates do help the dollar. And we go into the Bloomberg and we take a look at hashtag BTV 4925. This is a longer term chart of the Bloomberg dollar index. In fact, the Bloomberg dollar index is on pace for its best week since 2011, up more than 2.5%, a real move higher in the currency markets. And we see that move higher all the way over to the side there. But very interestingly, despite the fact that we have the Bloomberg dollar index up very nicely on the week, back above its 200-day moving average, which is something that's bullish, there is a possible head and shoulders pattern forming here, something that's typically bearish over the long term. So this will be something to keep an eye on, a little bit of a contrarian view there through the chart. Now, as for what drove stocks higher, there were a number of strong sectors, including the financials. We have the XLF, or the Financial Spider ETF, having its best week since 2009. And we go into the Bloomberg and we take a look at an XLF chart. This is hashtag BTV 4926. We see a long-term uptrend, and we also see that area of congestion over to the side. And just recently, the XLF has been trying to break out of that range. The buyers have really been trying to overtake the sellers. And on this week, we have this massive spike higher, suggesting that the buyers have, in fact, taken out the sellers, and that perhaps more strength is ahead for the financial sector.
Abigail Doolittle, thanks very much.
What'd you miss? The election of Donald Trump helped bank stocks rally to levels not seen in years. And then that is thanks in part to the belief that the Donald Trump administration will bring less regulation in the industry. So ultimately, what will this reexamination of regulation bring? Let's ask Tommy Sho. He's the CEO of Keefe, Bruyette & Woods. And Tom, we know that Donald Trump has said he wants to get rid of Dodd-Frank. He also still thinks banks are still too big to fail. So to that end, he does want to bring back Glass-Steagall as well to split commercial banks from investment banks. What is your best understanding of the kinds of changes that Donald Trump would want to make to the financial industry?
So I've seen a lot of different comments about what might happen. My own opinion is what's most probable. I think what's most probable will be elements of the two bills we've already seen in Congress over the past year in the House and the Senate. Typically, those bills do one of two things. They increase the tiering of regulation. I think that the biggest banks, the big eight, which are the global SIFIs, are still likely to get a lot of regulation. Maybe there's a little bit of easing, but they'll still be very significantly regulated. I think you're going to see more room for the mid and small cap banks, where they weren't the banks that caused the crisis, and really I think their performance has been slowed down. So I think that's really the big change. The second will be the CFPB.
We talk about regulation as if this as if it's this abstract thing, as if it's this thing that you just turn a dial and you have more or less regulation. But what specific things? So there's this idea out there now that if he can roll back some regulation, there could be more lending, more business activity. What specifically are the regulations that, in your view, have constrained lending and activity and that could be pulled back to encourage it?
I'll say there are two things. One is the current director of the CFPB, this is the Consumer Finance Protection Bureau, doesn't report to any governing body, nor does he get his budget from Congress. So that director essentially operates under his own direction, essentially. There is talk about whether he can or cannot be replaced by the president. I think most likely he probably could.
Has he had that much impact, though?
The CFPB's had a lot of impact around the industry. The second, I would say, is, for example, the $50 billion threshold. Dodd-Frank says that if you go over $50 billion, you get a whole nother level of regulation. You have to go through the annual stress test. It's a lot of work. It's a lot of money. And what happens is what's happened since they've passed the bill is banks slow down their growth before they get to $50 billion. It's not good for the economy to have banks slowing down their growth so they can avoid that extra expense of getting there. It has unintended consequences.
And as we, Oliver Rennick pointed out yesterday on the show, is really the small cap financials really surging even more than the big banks, perhaps on indication that people think the big banks won't benefit as much as the smaller ones from a pullback.
I'll throw another one to you, too, which is that banks do better when interest rates are higher and when the yield curve is steeper. Both of those things have happened materially. Smaller banks get more spread income than bigger banks, hence they're bigger beneficiaries.
So does he modify his views somewhat, or does the Republican-controlled Congress kind of move to his direction? My
feeling is we've already seen it in front of us, which is both the Senate and the House have passed these bills. I don't think any of them said, OK, we're going to unplug Dodd-Frank. Really what they're doing is they're amending Dodd-Frank.
OK.
Dodd-Frank is something like a 2,000-page bill. You're not just going to unplug it and start it all over again. Personally, I think that'd slow the economy down because of the uncertainty. I think you're better off making it better. And the problem was, of the 6 years since they passed it, there's been no appetite for, on the Democratic side of the Senate, to allow that to happen. Now at least you'll get some re-examination.
Okay, so there might be tweaks in there. Let's go back to the CPFB, which you said the director, the leader of that agency has a lot of control. Is it in the Trump White House's interest to dismantle that completely?
I think that conversation is going to have to happen. What I saw in the other bills that have been introduced to date have been saying, hey, look, let's put in a bipartisan governing authority over it, and let's make them ask Congress for their budget. Let's make that the first step. Believe me, even if they merge it into another agency, consumer protection is not going to go away. I don't think anybody wants to see that happen. But they have 1,500 employees right now, and the agency was born in 2010. Where is this headed as a big standing up agency?
At the same time, the agency is kind of leading the effort to find Wells Fargo over its bogus account scandals. And Wells Fargo, if nothing else, is a clear populist issue that has received a lot of bipartisan support.
I think no one's happy about what happened at Wells Fargo, and my view is that they would have been in trouble whether the CFPB was there or not. There should be some agency who's looking for that.
Trump's final ad of the campaign featured Lloyd Blankfein as a target. It featured the Fed. Janet Yellen was in the ad. He talked about Goldman Sachs. It was, a populist kind of pitchfork final closing message going after the elites of finance. Very quickly, it hasn't even been 72 hours, the financial industry seems to be very happy with how things have developed. Is it possible that people are, traders, people in banks, are being too naive about Trump having to fulfill the populist side of his mandate?
This is my own observation. The team that dealt with the crisis was still in their positions for the last 8 years. It was very hard for that transition to happen from let's stabilize and think about growth. Now we're starting over again with, I think, a new team that's going to be more growth-focused. I think that's what Wall Street's embracing. I think it's a re-examination of where we are, what we can change to help the economy grow more.
So does that mean they take some of what he's also said less seriously? For instance, slamming hedge funds and private equity for the fact that they don't pay high enough taxes. He, as Joe mentioned, has tapped hedge fund managers as some of his closest advisors. Do we presume that that kind of gets watered down or forgotten as well?
I think there really have not been there's not been an extraordinary amount of details in the proposals we've seen. I think that I think a lot of it is still on the come, but let's wait and see. I do think that there's a lot of energy for change, getting it right, fixing it. And when you look at the people who are now surrounding him on the transition team, I'd say most of them are very experienced people, which let's see what they come up with. But I think right now, the steps he's been taking has been sorting a more of a pro-growth mentality.
But the truth is we don't really know, do we?
No, but they're looking for signs, and the signs are that, and I really think the biggest sign is that we just needed a re-examination and a fresh look. Because if you think about it, I think it's incredible that the Dodd-Frank bill was passed, and over 6 years, it was never really amended. There's no way anybody thought that that was going to be perfect on the first attempt.
Especially at 2,000 pages. And if the health care law is any indication, there's a headline in the Wall Street Journal that President-elect Donald Trump says that he would consider leaving in place certain parts of Obamacare after the President Obama asked him to think again about repealing it.
I think we're going to we'll take big steps, but I think if you start all over, you're going to put so much uncertainty, and it takes so long to pass a piece of legislation like that, that could slow the economy.
Yeah.
And I don't know this for a fact, but my sense is there's a lot of energy to get this economy growing again.
All right. Thank you so much, Tommy Sho, President and CEO of Keefe, Bruyette and Woods.
Coming up, the CEO of the largest media company in the world, Bob Iger of Walt Disney, shares his thoughts on this week's election surprise. This is Bloomberg. I'm Joe Weisenthal. What'd you miss? Walt Disney's CEO Bob Iger weighed in on what a Trump presidency could mean for the company. He spoke with Bloomberg's David Weston about the media's controversial role in the election of the new president-elect.
So far, so good in terms of what I'll call transition, even though it's very, very early. I think both the president-elect, I was going to say the candidate, is no longer the candidate, president-elect and President Obama have approached this really smartly. Be cordial, be open, understand that the most important thing here is America, not one party or another, not one ideology or another. And so let's be gentlemen about it, and that's what they're doing. That's great for the country. For the country to see that, it just instills confidence in our country and faith that the future is good, even if your ideology is not necessarily represented in the next president of the United States. So I like what I've seen so far, and I think the country's reacting well to it. It's too early to really predict what the policies of a new administration would mean for this company. Believe me, I've gotten briefed on how they might affect us, but way too early to speculate publicly. What I can say, though, is that we've been talking a lot as a company and lobbying a lot about the need for a new tax policy. The corporate tax rate of the United States is the highest in the world. It's not competitive. It needs to get fixed. It needs to get lowered, and loopholes need to get closed. And we definitely believe we would benefit from that happening, and the sooner the better. And I think it's something that's going to be addressed. Might ensue, really too early to say.
So finally, Bob, you're a student of the media. I mean, you've lived your entire professional career in the media. You know it and you love it. It's not too soon, I think, to start asking ourselves the question of the role of the media in this election. I mean, it strikes me that this is a very different media than was in existence even 4 years ago, certainly 8 years ago. And certainly Donald Trump took full advantage of that, both in terms of being able to get access, particularly on the cable channels, but also in social media. Is the media starting to think about its role in future elections and what role it should be playing as the fourth estate?
There's a lot of hand-wringing about the media this week and its role in the election. And I think that hand-wringing is missing the point. And the point it's missing is that the media today doesn't look anything like the media of yesterday. We're living in a world where the sheer definition of media, and I'm talking about not the definition of what the industry creates, but the definition that the people create, is extremely different than what it used to be. How we get our news, what we consider news, how information travels, how fast it travels. It's vastly different. So I would argue that the media actually played a positive role in this campaign in the sense that it was ever present, which media is today. It was sort of eyes on, cameras on, voices about everything that went on. Everything was exposed. Everything was subject to scrutiny by the new media. That can't be a bad thing. Now, did the media get it right in terms of predicting the outcome? No. I think that deserves some scrutiny by the media, and how did they get it wrong? But I don't think the manner in which the campaign was covered is necessarily something that deserves criticism. You know, you can always be reflective about it. That's fine. There's nothing, I think there's nothing harmful about that. But what is media today? It doesn't look anything like it did certainly 5 years ago, 10 years ago, when I started my career at ABC 42 years ago. It's just different. And I think it's time that those that follow the media from a critical perspective accept the fact that the media they are following today is vastly different than the media they used to follow, or maybe than they think they're following.
That was Disney CEO Bob Iger.
It is time now for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. Alibaba is celebrating another record-breaking Singles Day. The biggest online merchant in China said sales have hit $17.8 billion. That easily beats last year's total. Singles Day is the biggest online shopping day of the year in China. Chairman Jack Ma said Alibaba could host a Singles Day in the U.S., EU, and Japan in the future. India's biggest feud is taking another ugly turn. Tata Group is now taking steps to officially muscle former chairman Cyrus Mistry away from the company permanently. Mistry was abruptly removed last month as chairman of the $100 billion holding company, but he did retain control of other units. Tata has lost more than $10 billion in market value since Mistry was removed. Facebook is adopting new tools in response to allegations of discrimination. The social network will no longer allow marketers to exclude racial or ethnic groups when placing ads related to either housing, employment, or credit. Facebook made the move after meeting with congressional leaders and the ACLU. Its ad system will now automatically disable any use of ethnic marketing. And that is your Business Flash update.
Up next, with the U.S. election now out of the way, Europe's focus turns to a series of its own votes over the next 12 months. One Italian referendum poll suggests problems ahead for Prime Minister Matteo Renzi. On the flip side, if there is one thing Brexit and the U.S. election have taught us this year, it's that polls can't always be trusted. We'll show you two ways of tracking that vote next. This is Bloomberg.
A beautiful late afternoon in New York City. I'm Scarlet Fu. What'd you miss? Technology shares on Thursday moved in the opposite direction from the market at a rate last seen in the aftermath of the dot-com bubble. So we talked yesterday about how the Dow Jones Industrial Average got a big lift as investors sought those old economy companies because Donald Trump's infrastructure spending would certainly give those kinds of companies a boost. At the same time, we saw technology shares. The growth companies had really been leading a lot of the gains back off. The FANG names, Facebook, Amazon, Netflix, and Google, all backing off quite a bit. And what resulted was the biggest divergence in percentage terms between the Dow and the NASDAQ since 2001. So the green horizontal lines show Dow outperformance, and the red horizontal lines show when the NASDAQ outperforms. And there you go. That circle right there shows what happened yesterday. Our thanks to Dan Curtis, by the way, who put this together. Joe was talking about it, and we were trying to go back to when the last time this happened. The last time it was this wide was back in 2001.
And it makes sense that it would happen in 2001 when the tech stocks were really leading the way down.
Yep.
There were probably a lot of really bloody days for the NASDAQ back then where the other markets weren't hit as hard.
Exactly.
Speaking of divergences, let's talk about Italy and Spain. We'll get to the divergence in a second, but people are looking for the next geopolitical trouble spots, where else there's a vote coming up that might go against the status quo. In early December, we have a referendum in Italy on a change to the Constitution that would make it easier to pass laws. Prime Minister Matteo Renzi has said he would resign, possibly, if it doesn't go his way. Well, you see on the chart, no is holding a pretty solid lead, not gigantic, but 52% to 48% according to recent polling. If you exclude undecideds, say they would not vote for this change. That could lead to the end of the sort of moderate Renzi. There's anti-Eurozone parties that are doing pretty well there. Now let's look at the market implications of this. I have a chart. This is the spread in 10-year yields between Italian debt and Spanish debt. You haven't compared the two because they're both peripheral countries, economically, arguably similar. The yield spread has been surging. You have to go all the way back to the end of 2011 or early 2012 for the last time Italy had to pay this much more to borrow relative to Spain. Of course, that was in the immediate aftermath of the Berlusconi era. It really shows, like, Spain, it took like a year for them to finish their presidential election, but people are not worried about politics in Spain. Very concerned about Italy, and you should keep an eye on that Italy and Spain spread because it's widening. Italian 10-year debt for the first time in a while, going above 2%, rising funding costs. This is a sign that people are sniffing out Italy as the next major spot that could suffer a geopolitical blow.
And I wonder how much of this is self-inflicted. Matteo Renzi didn't have to promise anything like he'll step down if the referendum doesn't go his way.
And maybe that's causing people to be more inclined to vote against it because they see a chance to get him out.
There you go. It becomes a referendum on him.
Exactly.
Forget the Constitution.
So bringing out his enemies.
All right. The market close is next. Let's get you a check of the major averages with less than 4 minutes to go before the close. You do have the S&P 500 down, ending 4 days of gains. The Dow, however, has moved a slightly higher, so extending its advance to a fifth straight day, up at 43, or I should say adding 44 points. Is that another record high for the Dow?
It probably is.
Yeah, it probably is.
Yesterday.
All right, it is a record high for the Dow. The NASDAQ rebounding as well, up 0.6%. This is Bloomberg. We're moments away from the closing bell. What'd you miss? The Dow closing at yet another record high. Bonds extending this week's sell-off, and commodities tumbling as traders parse the implications of a Donald Trump presidency for the world's biggest economy. I'm Scarlet Fu.
And I'm Joe Weisenthal. I want to welcome our viewers who are tuning in live on Twitter. You can watch our closing bell coverage every day on Twitter from 4 to 5 p.m. Eastern Time.
All right, let's begin with our market minutes. The Dow turned around and closed at yet another record high. You can kind of middling through most of the session today. Not a whole lot of volume given that today is Veterans Day and the bond market is closed. There was no economic data released today. Nevertheless, a record high for the Dow. It's the best week for the Dow Jones Industrial Average since 2011 this election week. And the S&P 500, its best week since 2014.
Sort of a slightly quiet end to an extraordinary week in world events and markets. Interesting that the NASDAQ rebounding a bit after losing pretty sharply yesterday.
And in fact, I was just checking the volume there. Volume on the Dow was off 39% from yesterday, and the NASDAQ off 20%. So clearly a big drop-off from yesterday's advance.
Absolutely. Except
the sell-off in the NASDAQ. All right, let's get you to equities right now. In terms of the winners and losers, commodity-related names really got hit here. You had energy getting dragged down by a slide in crude prices. Materials also fell by 1 1/3% as gold and silver prices declined. And some individual names to focus on. NVIDIA, which makes graphics chips used by computer gamers, gave a sales forecast that signaled strong demand as well as growth in new markets like data centers. So that was good for a 30% jump in the share price. Michael Kors, the handbag maker, worst rout in 6 months, down 4%. Weak tourism traffic and a pullback from department stores hurting its outlook. And if you look at how the broader market performed, we focus on the big caps, but I want to pay attention here to the small caps because you have the Russell 2000. It closed up 10% on the week, with, of course, most of the big gains coming Wednesday, Thursday, and Friday. Within the small caps, though, you really have to look at the financials because, as Tommy Sho, the CEO of KBW, was telling us earlier, these are the kinds of names that stand to benefit from deregulation under the President-elect Donald Trump. He did say that he wants to roll back some of the regulation. In Thomas Sho's reading, that's going to be more of removing some of the overhang, the regulatory overhang for the smaller and mid-sized banks, which have really been held back by the costs related to that regulation. So they say. And, of course, a quick mention of a big bank on the other end of the spectrum is Wells Fargo. This is something that Oliver Rennick pointed out to us earlier. This is a 3-month chart, and what you can see is that Wells Fargo has made up all of its losses since the bogus account scandal decimated its reputation back in early September.
The account scandal was real.
The account scandal was real.
But they were bogus accounts. But it was not necessarily a bogus account scandal.
Correct. But nevertheless, it's like it never happened when you look at the stock price.
Let's look at an extraordinary week in government bond markets. There's just incredible rout across the board. First of all, this is a chart of the Mexican 10-year yield, which earlier in the week was around 6%, now yielding 7.3%. The Mexican financial markets just getting absolutely obliterated still in the post-election environment. You know, maybe some people have thought that it would abate once the election was actually over. Not yet. Just absolutely get taken to the woodshed. Of course, we got to look at the U.S. So here's a chart of U.S. 10-year yields. Also a big jump. No trading today due to the holiday, but 2.15% on the 10-year levels we haven't seen in a long time, not since very early this year. Similar story in South Africa. Let's take a look there. There's not any sort of specific Trump-related trade, except that it was a very bad week for emerging market assets overall. Up to 9.18, started the week around 8.6, so very ugly there. And finally, Germany, because it's sort of an EM and DM story. 0.31 now on the 10-year. I mean, it wasn't very long that this was negative. So this across EM, across developed markets, from Mexico, which has a direct connection to the U.S., South Africa, which is just sort of in the general EM orbit, really bloody month or bloody week for government debt.
And, of course, we'll talk about this in just a bit. I want to look at currencies here. For the dollar, it was the biggest weekly gain since 2008. You had central banks from India to Indonesia stepping in to stabilize their currencies. One strategist says that the carnage in Asian FX is a reminder that the S&P 500 is not really the barometer you want to look at for Trump-driven risk aversion. It's Asian currencies. if you come inside the Bloomberg here, Joe had mentioned the Mexican asset class, or all Mexican assets being decimated. Here is the peso over the past 5 days versus the major currencies. And you can see that it lost ground versus every single major currency. It did the best, I suppose, if you could call it that, against the South African rand, and that the rand only gained 3.3%.
All the people trading rand peso out there.
Yes, exactly. For all those traders out there. But you can see that versus the dollar climbed 9%, 9.1% versus the peso. And the big winner here, surprisingly, was the British pound. And that gets me to the next pair that we want to look at. The last political freakout was Brexit, and the pound got sold hard. This time around, the pound was the big winner. And here, against the euro, the pound had its best week in more than a year. It appreciated in value against all 31 major peers since last Friday, which is incredible if you think about the fact that in October, the pound was the worst performing currency.
That is pretty remarkable. Let's look at two commodity charts that really tell the story of the week. First, we're starting with a one-week chart of silver. Silver got absolutely obliterated today. A lot of those precious metals not doing so well in the post-election environment, just getting decimated. There was a lot of bidding them up, people holding risk, hoping to find some safety in them. Ugly day. And then on the flip side, let's look at a one-week chart of copper. This is just incredible. It ended up, the rally faded a bit today, but look at that. We were below 5,000 a ton at the start of the week, and then it hit 6,000. Analysts are gobsmacked by this move of copper. Perhaps it has something to do with belief and demand from infrastructure. Unclear, really. But
that seems to be the narrative that fits right now.
Yeah.
All right, those are today's market minutes. We're going to take a deep dive now into the Bloomberg, and you can find all our charts using the function at the bottom of the screen. And you're looking deeper into copper.
Yeah, so here's a chart of every 1 week copper move going back 10 years or something. We actually came off our record high, but for 1 point briefly, it was the biggest weekly gain in the history of copper.
That's
unbelievable. You saw at that last chart, copper did sell off a little bit during the day, but that just goes to show how extraordinary. I mean, we had a couple bigger days. There was a day in 2011, 2008, but briefly in the wake of Donald Trump's election, Dr. Copper, because it supposedly gives the pulse to the global economy, had its greatest week in history. So amazing.
What I think is amazing about this move is that it's linked to U.S., the U.S. Outlook rather than China. Right?
Yeah, it's very unusual, very ahistorical that for once it appears to be about
Usually it's always a proxy for China and the economy and how much demand there's going to be from China.
Totally right.
Nevertheless, all right, I'm going to focus in here on the plunge in bonds, the weekly plunge in bonds, because the surprise election of Donald Trump was a game changer for global bonds. As Joe was telling us, more fiscal spending means a bigger budget deficit, means inflationary, means a December rate increase, which means a quicker pace of tightening in 2017. And Eric Lonergan, Joe, was telling us yesterday, he's a fund manager at M&G, that people woke up to the realization that these are not risk-free securities anymore, right? There are risks in bonds, and you see it right here. You see a drop-off here in the value of bonds. More than $1 trillion wiped out of bonds, according to the Bloomberg Barclays Multiverse Index. That's pretty incredible. And, of course, it's the yields on the longer-dated securities, the 10-year, the 30-year, that are most sensitive to inflation perceptions.
Well, let's talk more bonds. I want to get more on the sell-off with Ian Lingen, head of U.S. rate strategy at BMO Capital Markets. Ian, thank you very much for joining us. So, as Scarlet showed, absolute massacre on the rates front this week. Is this just the beginning, or is it perhaps a bit overdone, people overreacting to some idea of policy change out there?
Well, they certainly have seen a significant regime shift, and now we're in the process of justifying it. We're looking to the data.
It always works like that, right?
We're trying to figure out what the composition of Trump's cabinet will be, and that will have implications for whether or not we're able to see these fiscal measures go through. And so we're in the process of consolidating in the Treasury market. We believe that the first leg has gone, and now we're going to define the new higher yield range. We're seeing it across a lot of different asset classes, and it is really a fascinating time.
It is a fascinating time, and of course, if Donald Trump is going to go forth with all his infrastructure spending plans, that potentially means more debt having to be issued. The U.S. government did sell debt this week, and the demand was not quite what it had been in the past. The bid-to-cover ratios were lower. Is that a sign of things to come for when the government does try to sell those longer maturity bonds?
Well, we had a couple things. We had very low bid-to-cover ratios. We had high tails, which is the the amount that you have to pay, or the discount that you get for buying it at auction. And those are the two key things that we primarily focus on. And yeah, I really think that that is going to be a real risk for the next year and a half as we look forward to the increase in Treasury issuance. We'll probably see another 500 to 700 billion in issuance, and I think that that's going to be a key focus that puts upward pressure on yields.
Could people be getting ahead of themselves, though, just on this fiscal thing? I mean, I've thought for a while that Trump presidency probably would be more fiscal liberal than a divided government, but I'm still wondering whether people have really sort of gotten ahead of themselves in the sense that A, we don't really know how the politics are going to play out, and B, it's not that easy to get money out the door fast, particularly infrastructure. There aren't 1,000 bridge projects that immediately need to be worked on. And there's not that much labor to immediately hire them. We're at 4.9% unemployment. So is all this a little premature, perhaps?
I think the market could arguably be getting a little bit ahead of themselves. And more importantly, if you see any of these initiatives go through, it'll be short-lived because government spending tends to have a short-lived impact on real GDP. And what we'll be focused on is what it means for inflation. And I think that that's what the Treasury curve is responding to.
What is the connection, in your view, between government spending, debt, and inflation?
So the more government spending, the more at this stage in the cycle, that the more net Treasury issuance that we're going to see. And it is simply reshifting the way that reshifting consumption. You're bringing forward consumption a bit. If you think of it that way, you spend now, you borrow to do it, and we eventually will have to pay that back. And I think that that's what the market's worried about.
How does this play out in Europe, where we've also seen the yield curve steepen, or in Japan? And a lot of it feels like the yield curve in the U.S. is steepening. Everyone's selling off treasuries. So we're also doing that to some extent in Japan and in Germany. But is it going to play out in the same way?
We're dealing with very specific U.S. risks. And I think that the reason that the rest of the market is moving in tandem or somewhat in tandem is a function of the fact it's such a globalized market. And when the U.S. is facing inflation pressures, if you look at the investable alternatives around the world, you have to say, well, I'm going to need a higher yield to invest in JGBs. I'm going to need a higher yield to invest in Europe. There was a point made earlier on the show, I think it's a very valid one, is Europe is now facing a lot of the same problems that we've seen in the UK and here in terms of the upcoming Italian election. And I think that that's going to be important. I think all eyes are on that right now.
The move that we've seen in rates, particularly in components of the rates markets that are tied to inflation compensation, really moved pretty dramatically. What does it say that the election of Trump seems to have done more for this corner of the market than any words from Janet Yellen or Mario Draghi and so forth?
Well, one of Yellen's key criticisms about prior governments have been that they haven't followed through on the fiscal side. And the fiscal side is key, and it's very inflationary. And I think the markets are telling us that if Trump's able to deliver on the fiscal side, that we should see more inflation.
All right. Thanks to Ian Lingen, head of U.S. rate strategy at BMO Capital Markets. Really appreciate you coming on this amazing week.
Thanks for having me.
Coming up, the dollar heading for its biggest weekly gain since 2008, prompting central banks from India to Indonesia to step in to stabilize their currencies. We're going to look at the ripple effects of his trade policies. This is Bloomberg. What'd you miss? A wild ride for markets this week since Donald Trump's presidential victory. The S&P had its best week since 2014. Bonds have tanked, and the dollar enjoying its biggest weekly gain since 2008. So here to round out the week is Bloomberg News Global Economics Executive Editor Dan Moss and our Bloomberg News FX strategist Vince Signorella with his decades of experience trading currencies. I want to start with China. And Dan Moss, this is a quote from a Bloomberg View contributor, Michael Schumann. He says that the problem with Trump's approach is that he's fighting yesterday's war over yesterday's industries and jobs while aiding China's pursuit of tomorrow's industries and jobs. And this is in relation to Trump's rhetoric on China, his get tough rhetoric on China. Michael Schumer writes, rather than bring China to heel, he will help the country compete with U.S. companies in the businesses of the future. So his basic take here is that Chinese policymakers are pushing for a nationalist agenda, and Donald Trump's nationalist surge will only serve China's economic interests. I know you've been thinking about this and writing about it.
It's a very different type of China, Scarlet, from the China that Barack Obama inherited from George W. Bush. It's much bigger, for sure, but it's also growing at a significantly slower pace. It's no longer dominated by exports. This is a consumption services economy. And the current account deficit, surplus, that cause of so much angst, was 10% when Barack Obama it was 10% of GDP when Barack Obama took over from George W. Bush. It's now 3%. According to the IMF, it will be practically zero by 2020. So this is really yesterday's war. It's not about T-shirt makers in Guangdong anymore. It's about Starbucks in Beijing.
Vincent, this extraordinary week for markets. I think most people got most aspects of this week wrong, whether it was the election itself or the aftermath in the markets and how markets would react. What is your sort of big takeaway about how people are viewing the new regime?
Well, I think about the only thing markets got right was the day ended in Y. The big take is that, Trump is the wow factor. The infrastructure spending approach that he's put forward has given a break for central bankers. He's done what Draghi's asked the markets to do. Please expand fiscal policy, take this off our plate, because monetary policy is in effect at the end.
Dan, this is we had this shocking thing on Tuesday night where the odds of a December rate hike plunged to about 50%, and now they're above where they were before the election. How do you think the Fed is going to approach this question of a monetary offset to fiscal stimulus? As Vince pointed out, fiscal stimulus is what the central bankers have been asking for a long time. It's driven inflation expectations up. But will the Fed now feel like it needs to hike a little faster than it otherwise would have to offset those inflationary impulses?
They'll approach it very cautiously. Don't look for any radical shift at the December FOMC when the markets do suggest, and comments from policymakers indicate, we'll get a rate increase. Nothing that Donald Trump has said during the campaign has yet become policy,
right?
Let alone passed.
I feel like we got to, A, hammer that point home a bunch of times, and B, there were many conflicting messages on the campaign, so we really know very little.
Taste the sausage at the end. Let's see. I mean, the process of making the sausage is going to be very... Who knows what is going to come out the other end, and that's what policymakers are going to focus on. In December we'll get the famous dots and we'll get the forecasts as well. The expectations are it will continue to show, Joe, a very shallow path of rate increases, maybe 2 rate increases next year, and the new rate of neutral will continue to come down.
I want to go back to the idea of China, though, because President-elect Donald Trump really brought it up and hammered it home, and maybe it was used as a scapegoat for a lot of the problems that the working class faces right now. You brought us a chart which looks at GDP in China versus GDP in the U.S., and they're both in U.S. dollars, so you can really compare it like with like. Of course, the U.S. is in white, China is in blue, and China is certainly catching up. What does Donald Trump see? Where does he want this to go? Does he want the U.S. to surge up and China to move in parallel, or does he just want China to go down? How does he interpret something like this?
Well, I think every U.S. president wants the U.S. to continue to go up. The great irony amid all this talk about branding China a manipulator on day one, right now, if China's manipulating the currency, it's to prevent it weakening.
Correct.
Again, something unforeseen when Barack Obama took over from George W. Bush. So does Donald Trump really want a weaker yuan? I suspect not.
Vince, what in the currency markets this week, emerging market currencies absolutely got smashed. These currency, carry trades got obliterated as U.S. yields went up.
Sure.
How do you see that going forward? Are these still in free fall, or will people, in your experience, look to take a flyer here?
I think there are different aspects to different currencies. I think LATAM may be getting closer to a more smoothing pattern, but currencies like Australia and New Zealand, where the monetary divergence is really syncing up, might have a bit more pressure on them in the future.
Why would Indonesia and India intervene? I thought everyone wanted a weak currency.
People want a weak currency up to a point. It does drive inflation, and that's all part of the entire picture.
All right, so it was the rapidity with which that currency...
It's the speed by which it declines.
Got it. All right. Vince Signorella, thank you so much. Dan Moss, thank you as well for your perspectives. Much needed after this crazy week.
Coming up, investors are fleeing emerging market ETFs after Trump's surprise victory. We're going to look at some charts that you cannot miss next. This is Bloomberg. I'm Joe Weisenthal. What'd you miss? President-elect Donald Trump's America First message is already influencing the markets in a major way, and you can really see it in emerging market ETFs. Joining us now to discuss this is Bloomberg's Luke Kawa. Luke, you've put together a pretty extraordinary and telling series of charts looking at the immediate fund flows since Tuesday. What do you see?
Yes, so essentially one of the big things you see, the overarching theme is they're leaving emerging markets. Investors are, they're voting with their feet, and that's the main place you see it. And so one chart that you can show is the EEM, so the iShares, it tracks the MSCI Emerging Market Index.
And that's Joe's chart right there.
I have that on my terminal. Let's check that out.
49.19.
So what you see there is it's
huge outflows in the last few days from this popular emerging markets.
Yes, and that's 1.5 billion on the Thursday, and that was the most since 2011. So absolutely huge.
But, you notice that there aren't that many green lines which show inflows. And if you come inside my Bloomberg, which looks at emerging market bond ETF flows, you can see that really you've seen a lot of money go in here. But again, this past week has seen a huge outflow in bonds as well.
Yes, like both those two ETFs, they've taken in still, even after these huge sales, over $4 billion this year. Total inflows, but this one, that's a record outflow. That's over 300 million leaving, and the largest geographic weighting in that ETF, Mexico.
And the bond funds, these are dollar bond funds, really getting hammered, in part rising U.S. interest rates. I mean, there are multiple factors here, but rising U.S. interest rates make a lot of the case for going abroad for yield a lot less compelling.
Exactly. You don't have to, stand up on your tiptoes to reach for yield anymore. It's available here in the U.S. more and more as this bond sell-off comes about. So you have that, and then you mix in the kind of protectionist overtures that you've had throughout the presidential campaign, and you start to think you could lose access to the U.S. markets.
So it's a relative yield rather than fundamentals. The fundamentals of emerging markets didn't necessarily change.
Didn't necessarily change. I mean, you have commodities coming off. By and large, Bloomberg Commodity Index has kind of made that nice move downwards since the election. Not the hard commodities.
Not copper, iron ore, and some of these. Some of them have done well. All right, let's talk about the America First side of this, because obviously we saw the EMs get hammered. This is a look at flows into the SPY ETF, the popular S&P ETF that literally everybody knows. They're surging.
Yes, so that's over in 2 days, Wednesday and Thursday. That's over $7.5 billion in inflows cumulatively, and that's the most you've had since the markets were kind of snapping back last September after the yuan devaluation, we went haywire. So folks are really piling back into American assets, and that's more than outweighing the selling you're seeing in these emerging market funds.
And in terms of which American assets are piling into, financials have gotten a huge amount of that money. This is the Financial Select Spider ETF, which is, of course, XLF. And if you come inside, you can see here this spike right at the end, showing you how much money has moved right into financials, because Donald Trump has said he's going to get rid of all the financial regulations and repeal Dodd-Frank.
Yeah, so the double whammy that hit emerging markets was, the rising yield and protectionism, and this is the double whammy is rising yields and deregulation are helping the financials, and particularly the steeper curve. If you're engaged in the business of maturity transformation, that steeper curve, it completely explains the relative outperformance of financials in the U.S.
All right, Luke Cowett, I think these charts tell the story so clearly, so thank you very much for putting them together and coming up.
All right, coming up, we're going to stay on the emerging market theme, as Bloomberg's Luke Cowell was just telling us about how emerging market bonds have extended their rout and stocks have been falling to 4-month lows. We will discuss this further. This is Bloomberg.
It's time now for First Word News. Vice President-elect Mike Pence now leads Donald Trump's transition team. He replaces embattled New Jersey Governor Chris Christie. Trump reportedly wants to use Pence's Washington experience to move the process along. An executive committee, which will include members of Congress, will advise Pence. House Speaker Paul Ryan and Senate Majority Leader Mitch McConnell are urging the president-elect to select Reince Priebus as White House Chief of Staff. According to CNN, both leaders say the Republican National Committee chairman is the best choice. Steve Bannon, Mr. Trump's campaign chief, is also said to be a candidate for the job. At least 4 candidates may be seeking to lead the Democratic National Committee. The Boston Globe says DNC Vice Chairman Ray Buckley is considering a run for the top job. Former Vermont Governor Howard Dean says he wants his old job back. He was DNC chairman from 2005 to 2009. Minnesota Congressman Keith Ellison is expected to make an announcement on Monday. And former Maryland Governor Martin O'Malley says he is taking a hard look at the job. President Obama says there are lessons a divided nation can learn from its military. As he led his final Veterans Day observances at Arlington National Cemetery, the president said Americans must find strength in what he called our common creed and to follow the example of those who serve by being united in what he called our great diversity.
Soldiers, sailors, airmen, Marines, and Coast Guardsmen who represent every corner of our country, every shade of humanity, immigrant and native-born, Christian, Muslim, Jew, and non-believer alike, all forged into common service.
This morning, the president held a breakfast reception with veterans and their families at the White House. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlet, back to you.
Thank you so much, Mark. Let's get a recap of today's market action. The Dow shrugged off some early weakness, closing higher at yet another record high, up 40 points, 18,847. The S&P 500, though, could not extend its gains to a 5th straight day, closing down about 3 points. The Nasdaq rebounding. But, Joe, because it was Veterans Day and because the bond market was closed, we really saw the volume drop off from yesterday.
Yeah, not a lot of volume, but a pretty, the quietest day this week from an equity market perspective, but still pretty dramatic from currencies, international rates, commodities, huge day in copper up and down.
And the Trump trade continues, whether it's copper or whether it's small cap financials.
Right. So still plenty of action, including EM. It's been an extraordinary week for emerging markets, both EM bonds and stocks feeling the pain in the wake of Donald Trump's election victory. Earlier, I spoke with Bloomberg News markets reporter Sid Verma on why emerging markets in particular look so bad in this post-election environment.
The Trump victory means a lot of things. It means a lot of bad things for emerging markets. Trump represents a clear break in the global international order since he's campaigned on a very anti-trade stance. And the raison d'etre of the emerging market asset class pretty much for the last 15 years has been increased globalization, increased trade, lower tariffs, a reduction in protectionism, all buoys emerging markets. It buoys emerging market trade and it buoys capital flows. So a lot of investors are very worried. They're worried about what it means for the asset class, but they're also worried about the short term, given the fact that we've seen a huge global bond sell-off. About $1 trillion in value of global bonds has fallen.
We've seen a pretty sharp surge in interest rates in developed markets, U.S., Germany, U.S. 10-year yields above 2%. What do higher DM yields mean for popular EM trades in the short term?
Well, a lot, and it's very negative. It really reduces the allure of investing in emerging market debt because emerging market debt is supposed to offer higher yields to compensate for higher risk. However, if developed rate markets are offering a higher yield, then the competitive allure of emerging market assets is correspondingly reduced.
There's this belief that Trump is going to unleash this big infrastructure boom. We don't know if that'll happen or not. But historically, hard commodities and emerging market assets often move in tandem. Why won't all this demand for raw materials be more beneficial to the rest of the world?
Traditionally, commodities which have been driven over the last 15 years thanks to China's rapacious commodity import demand has been a real huge beneficiary for emerging market economies from South Africa to Brazil. This time it seems to be different. If the import demand, commodity import demand, is from the US rather than China, then there really is a US growth impulse. And if China is not the source of commodity demand, then it could really be negative because it means that emerging market nations are not necessarily driving the growth.
You know, you mentioned China, and of course, Trump during his campaign talked a lot about China and often antagonistically, particularly from an economic point of view. Have we seen anything in the markets yet this week, or what do we expect to see where we start to see out ramifications from Trump on Chinese financial markets specifically?
Well, we have seen suggestions, leaks, that he will formally brand China a currency manipulator. The practical implications of that might be lower than the symbolic implications. It's not clear whether it will have a big short-term impact. It might just mean that Chinese goods might have a lower role in the procurement government process in the United States. But clearly, the big question is what will happen to the renminbi. There have been, significant weakness in the currency for the last couple of months, and that really could intensify, which will be exacerbating the geopolitical tensions if China's currency is depreciating at a time when, Trump has argued on the campaign trail that China uses an artificially undervalued currency to boost its exports.
That was Bloomberg News Markets reporter Sid Verma.
Coming up, could the Trump era actually be good for Democrats? We'll explain how that might come to fruition. This is Bloomberg. Scarlet Fu. What you missed after Donald Trump's historic Election Day upset, Democrats are left with one question: what now? Bloomberg View columnist Connor Sen has an answer that could provide the Democrats with some solace. He says the Trump era will be great for the party. He's joining us from Atlanta with more details, and Sahil Kapoor of Bloomberg Politics is in our Washington bureau as well. Connor, let me start with you, because in your column you wrote that just as there are business cycles, there's a clear political cycle at work as well, and it could be that a Trump White House and a Republican-controlled Congress might lead to gains for the Democrats in 2018.
Yeah, so it's sort of, if you look at where we are right now, it feels a lot like where we were after the 2008 election, where Republicans were wiped out up and down the board. Democrats had all the levers of government. They had, for a while before Scott Brown won Massachusetts, they had 60 votes in the Senate. And basically what happened was, first in 2009, in the two gubernatorial elections in Virginia and New Jersey, Republicans won, Chris Christie and Bob McDonnell. And then in 2010, after the passing of Obamacare, you had a huge Republican Tea Party wave that started to shift the balance back, and that could be what the next 2 years look like for Democrats.
Sahil, if we're going to extend the analogy, then that would imply that we're going to see some sort of emergence of a Democratic Tea Party, something much more ideological, left-wing. In your reporting, does it look like that's beginning to emerge as the new face of the party?
Joe, there's some inklings that there's going to be a shift to the left in the leadership of the Democratic Party. Bernie Sanders and I believe Elizabeth Warren are on board to have Keith Ellison, the co-chair of the Congressional Progressive Caucus, a very progressive figure, run the DNC. That's gaining a lot of momentum. And yes, there, in the process of all these recriminations, the conversations I've had with Democrats are that, number one, they're still trying to sort through the wreckage and understand how this happened to them and where they screwed up so badly. And secondly, people like Bernie Sanders, who had a different theory of how to appeal to voters, primarily on the basis of socioeconomic class rather than identity, things like gender, race, and ethnicity, are gaining traction. The old theory clearly did not work, and Democrats have a lot of thinking to do. So yes, there are indications that at least at the top levels of the DNC, which is in line for significant changes, there will be. On the other hand, in Congress, Chuck Schumer is prepared to take over the Democratic caucus in the Senate, and the indications are that Nancy Pelosi isn't going anywhere in the House.
All right, so Bernie Sanders, Chuck Schumer, Nancy Pelosi, these are names that we've been dealing with for decades now, Connor. The problem for Democrats is they don't really have any young talent in the pipeline. Even Elizabeth Warren, who Sahil mentioned, is not someone who you can count on to be there in 20, 30 years necessarily.
Right. So this is sort of the generational transition we've been going through, where Republicans sort of had their transition from baby boomers to Gen X, and obviously Trump sort of is a sort of special case, but they had Nikki Haley, Rand Paul, Mike Lee, Ted Cruz, people like that, and we're kind of due for that Democratic wave, and so that's likely to start in 2018.
Going back on this question, Sahil brought up something interesting, which is that the Bernie Sanders wing of the Democratic Party wants to appeal to people more on the basis of economic class as opposed to racial or gender identity. That being said, it doesn't necessarily feel like that's where a lot of the left is. Isn't that going to be kind of a problem in terms of creating the new Democratic movement, that there is this big split ideologically, even among the far left?
Yeah, I think it'll be interesting.
Sahil, then Connor. You both can answer.
Right. No, so, Joe, it's a difficult balance to strike, right? Because Democrats have what's known as the rising American electorate, Latinos, Hispanics, and millennials, who have their, who have their own unique challenges, as well as African Americans who have their unique challenges as communities. So yes, the Democrats have to continue to speak to them. But what happened in this election, what went so wrong, was that Democrats were absolutely decimated among white working class voters, and the Democratic Party thought this wouldn't be that big a deal, that they couldn't really lose any more than they already were. And as a result, they ended up losing Pennsylvania and Wisconsin and Michigan, and Trump cracked the great blue wall as a result. So yes, they have to find a way to win back these folks, and their current messaging clearly did not work with them, and that's why they have to try to reach them in the theory of someone like Bernie Sanders on the basis of their economic struggles rather than their identity.
Connor, your view, doesn't the party need to come up with some sort of synthesis? The Tea Party was everyone got behind that in the Republican Party in 2010, essentially. Aren't the Democrats going to have a harder time doing the same thing, recreating that magic?
I think what's interesting is that both with the Tea Party and Donald Trump, the party establishment fought it in both cases, and sort of the core demographics won out. So instead of listening to the GOP autopsy, reaching out to young people and Hispanics, they really doubled down on the core message and won over the Midwest working class whites. And I think what could happen for the Democrats is kind of the same thing where, maybe instead of, the party might want to move back towards the Midwest, but the core demographics might be in places like suburban Atlanta, where I am right now, in places like Gwinnett County, which is rapidly diversifying, went for Romney by 9 and Hillary by 6. And so what we could see is that instead of going back to Michigan, maybe it's the suburbs of Atlanta and Houston and Dallas and places like that.
Meantime, President Obama's Democratic agenda, his progressive agenda, might be in the process of being dismantled over the next couple of years. Sahil, today President-elect Donald Trump signaled some flexibility on Obamacare in an interview with the Wall Street Journal. What did we really learn here?
So Donald Trump said that he is open to keeping certain parts of Obamacare, also known as the Affordable Care Act. This is interesting on a number of levels. Number one, Republicans have spent the last 6.5 years campaigning under the banner of repeal and replace. They say they want to eliminate every word of the Affordable Care Act. What Trump suggested is that he wants to keep two popular components of the law, two of the most popular things in the law: the ban on the ban on discrimination against people with pre-existing conditions, and a provision that lets kids or young adults as well under 27 stay on their parents' plan. These proposals have currency among Republicans. There are a number of Republicans in Congress who realize they're popular and want to keep them. The big problem is how you do this economically. You can't guarantee coverage for sick people and not have a mechanism to bring younger and healthier people into the pool to spread risk to avoid the spiral of rising costs. And you can't do it without some mechanism of subsidies to help them afford it. So that's the big problem Republicans have. They've essentially been saying, they want to have a diet of all sugar and no vegetables, and you can't do that without these unpopular components. And that's the big piece of this. That's the big reckoning that Republicans have to have on a policy level with health care that they haven't yet.
And when investors look at the Affordable Care Act, Connor, how much do you think they are factoring in that Trump is willing to be flexible on this as opposed to repealing it outright? I mean, we've already seen investors jump ahead when it comes to financials, when it comes to infrastructure companies. Do they have any direction when it comes to health care?
I think there's this knee-jerk response that, assuming that a Trump era will mean less regulation and less pressure on healthcare companies, but you're talking about a guy who's in his 70s with a coalition that's older as well, so it's not hard for me at all to imagine that Trump could reach out to Bernie Sanders or Elizabeth Warren and say, hey, let's go after the pharma companies. So I think markets might be getting a little ahead of themselves in terms of what's going to happen in healthcare.
Sahil, real quickly, obviously, you can't talk about Trump's platform without talking about immigration. The wall was the most consistent policy plank right from the beginning. Does it look like they're really going to pursue the wall?
Every indication from Donald Trump and his campaign so far is that he intends to make good on these promises. He intends to build a wall. He intends to cancel the president's executive actions and beef up border security. The big question is he going to get the money for it? Can he find the money in the Department of Homeland Security? It seems doubtful. It could cost billions of dollars, as much as $25 billion, according to one estimate. And Paul Ryan was asked about this. House Speaker Paul Ryan was asked about this on Fox News yesterday. He said he's in support of some sort of physical barrier, but he stopped short of flat out endorsing the wall. So that's a big question. One thing we have not heard from President-elect Trump or his campaign since he won the election is that he's going to try to make Mexico pay for it.
All right. Thank you very much, Sahil Kapoor of Bloomberg Politics, and Connor Sen. You will be sticking with us where we're going to be talking about the Federal Reserve and the market implications of the victory. This is Bloomberg. I'm Joe Weisenthal. What'd you miss? Donald Trump was a vocal critic of the Federal Reserve when he was running for president. But what will he do once he's in office? Bloomberg View columnist Connor Sen is still with us to help us figure this out. You know, I want you to put on your portfolio manager hat for this conversation. Donald Trump has been pretty all over the map on aspects of economic, monetary policy. But obviously, the markets had a pretty decisive reaction to his victory. What are your key takeaways from what we've seen so far, and what will you be looking for on the eco and monetary policy front?
I think the rubber's really going to hit the road in 2018. And the reason I say that is because 2017 is going to be figuring out what kind of stimulus he wants to pass, what's actually passable between what Democrats want, Republicans want, and Trump wants. And then, as you pointed out on an earlier segment, infrastructure spending is pretty slow. It takes a long time to pass through. And so, you know, between what we're seeing in housing, continued improvement there, already pretty close to full employment, by 2018, we should really start to see these inflationary pressures if they're going to emerge. And that's also when Janet Yellen's term is up. And so the question is, how is she going to handle the sort of Trump stimulus? And then if she sort of fights the stimulus on the monetary side, what will Trump do in terms of reappointing her or replacing her?
And in fact, we actually spoke with one of Trump's economic advisors earlier today on monetary policy. Her name is Judy Shelton. And we asked her about the future of the Fed and whether or not Janet Yellen would stay on. Let's take a listen.
I can't imagine why she wouldn't. I mean, it's her option. The Fed is independent and will remain independent.
Yeah, so the Fed is independent, but there are some appointees, or there are some names that he could throw in the place of Janet Yellen. And we also have, the vice chair nomination coming up, too, right? Stan Fisher's term.
Yeah, because he was nominated basically at the same time.
So if nothing else, we know that Donald Trump is the ultimate pragmatist. Does pragmatism mean that you keep on Janet Yellen and Stan Fisher?
I think the first thing to look for is there are currently 2 open seats on the Board of Governors, partially because Republicans in Congress have blocked President Obama's appointments. And so presumably those are going to get filled. And so who is he going to fill those spots with, and what are those people going to look like? So, you know, for instance, under George W. Bush, he appointed Bernanke first as governor and then eventually as the replacement for Greenspan. And so maybe there'll be a similar thing here where he'll appoint somebody on the board, and then if he's happy with that person, he will then appoint that person to replace Yellen in 2018.
Obviously, we've seen with sectors some pretty dramatic reactions. The banks have been surging, perhaps for 2 reasons. One, the steepening yield curve, and the other being hope, or probably, you know, this idea that there's going to be deregulation of the banking sector, and that help. Do you think investors are getting ahead of themselves, thinking that they already know what a Trump administration's policy would look like?
Absolutely. I think right now it's almost like when you first fall in love and you see in the other person exactly what you want to see, and you don't think about the fact that they leave their towels on the floor and they might start a trade war with China. And so we just have really no idea what he's going to do. The inflationary part makes sense between stimulus and reducing trade and immigration. Outside of that, who really knows what he's going to do?
I'm going to quote a line here from 16 Candles when the dad tells Molly Ringwald that that's why they call it a crush, because later on it hurts.
That should be in some strategist note next week. Connor Sen, Bloomberg View columnist, thank you very much for joining us. Thanks.
All right, it is now time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. Donald Trump's transition team is scaling back expectations of repealing Dodd-Frank. That's according to the Wall Street Journal, citing people familiar with the matter. Now, they say that the team plans to focus on rolling back the most disliked provisions, such as the Financial Stability Oversight Council's ability to name large non-banks as systemically important and subject them to more regulation. It was another record-breaking Singles Day for Alibaba. China's biggest online merchant says that sales reached $17.7 billion, easily beating last year's record total. Singles Day is the biggest online shopping day of the year in China. It is bigger than Cyber Monday and Black Friday in the United States. Chairman Jack Ma says that Alibaba could host a Singles Day in the U.S., EU, and Japan in the future. And Facebook CEO Mark Zuckerberg is pushing back against the idea that fake news on the social network influenced the U.S. presidential election. Speaking in California, Zuckerberg said that echo chambers aren't really a problem on the site. Some critics say Facebook let false information run rampant on its site and that its algorithm tended to amplify the voices that people wanted to hear instead of providing a full picture of what was actually going on. And that is the Bloomberg Business Flash. Perhaps Mark Zuckerberg should take a look at my news feed, which is basically, a bubble.
Yeah, a lot of people are avoiding their own news feeds right in the immediate wake of the election from everything people are saying. Coming up, what you need to know to gear up for next week. This is Bloomberg.
What you miss? The U.S. stock market making a bit of a comeback, at least when it comes for the Dow, because it was down earlier today and then it closed higher at yet another record high.
So I think the Dow was up all 5 days this week.
It was.
Pretty,
and the S&P 500 almost got there, but it did finish slightly lower. But the bond market was closed, so the drop-off in volume was notable.
Not much action today.
All right, don't miss this. Next week, you've got Walmart, Home Depot, and the Chinese tech company Tencent reporting results. So lots to look forward to on that front.
And there's going to be a slew of economic data next week. U.S. retail sales, housing start. The big one, CPI on Thursday. We'll see if that inflation pressure continues to brew.
Yeah, inflation expectations have been rising, but what about the actual print? And don't miss this. President-elect Donald Trump will be meeting Shinzo Abe, the Prime Minister of Japan, on Thursday as well. Fed Chair Janet Yellen will be speaking too.
That Trump-Abe meeting is going to be pretty interesting.
Absolutely. That's all for What You Missed. Thanks for watching.
We'll see you back here Monday. Have a great evening. This is Bloomberg.